Our headliner, he helps oversee more than $8 billion in assets under management. Christopher Toomey is with Morgan Stanley Private Wealth, joins us once again. It's good to see you again.
Thanks for having me again,
Scott. Well, what a time to get your insights. So, I mean, I don't know how much of our conversation you heard leading up into the interview with you. What are your thoughts on where we are? Where should we be positioning?
Well, I mean, look, if we take a historical view of the S&P 500, since the 1940s, the average return's about 11%. The average inter-year pullback is also about 11%. And typically from the bottom of the market cycle to that first 5% pullback is about 60 days. So we're about 80 days since the market bottom. And this is a 5% pullback. This is what it feels like. So we're actually basically due for a pullback given how far we've come. And what I would say is that our thesis really hasn't changed. Conditions haven't gotten worse. They've only improved across all of the fronts that we follow. If you look at fiscal policy, we're in a situation where the Senate's going to vote on potentially a $1.9 trillion stimulus package. That's going to be 50% bigger than CARES last year. If you look at the monetary front, we got news this week with Chairman Powell reiterating the fact that he's not going to be changing course. The vaccine data continues to be better than expected. 70% of hospitalizations and new cases down. And then if you look at the economy, whether it's GDP estimates or today's employment number, they're all very positive. So, I think John Rogers is a phenomenal investor. I recognize the concerns with regards to what's going on in technology, but we're not necessarily really concerned about the S&P 500. We think that this is a very good time to be adding money.
I mean, of course, everything you said is right. But also, the market's not selling off because there's all of a sudden bad news. Of course, there are many great things. The problem is that things may get too great, right? And too hot. And that would push rates up to somewhere beyond what the Fed is maybe able or willing to do. And that's why the upset is happening in the market. What do you think?
No, I agree. I think, look, we are seeing a situation where the 10-year tripled. And obviously, there's concern when something like that happens. But you also have to look at the absolute level of where rates are right now. You had Rick Reeder on, I think, last week. He's obviously one of the great investors in the fixed income market. And he kind of poo-pooed that. He's talking about the fact that rates are still negative in a real sense. And so in our minds, we're not necessarily in a situation where we anticipate inflation really being a secular problem. We think it is a transient problem. We think as the economy opens up, a lot of the issues that are going to be created, it's not going to be just like flipping a switch and things are going to go back online. There's going to be some cost controls, cost issues that are going to affect the economy. But we think all of that is positive for stocks. And I think it's important to note specifically around tech, look, we have been market neutral or market underweight with regards to tech. And what we're seeing right now is a rotation out of tech and into the cyclicals. It's been happening since October, and we think this is normal. The opportunities now that we're getting more and more certainty about the economy opening means that there's more opportunities outside of tech for great growth. And I think that's just what the market's reacting to.